key question. Are we starting to see signs of a deceleration in demand, to Mandeep Singh's point, or is this just noise because of differentials, because of circumstantial issues, because of supply chain disruptions? That's going to be really at the heart of a lot of jobs data as we try to take out how much weakness a lot of these companies see persisting coming from demand, not just supply side issues.
I find the dollar thing strange. The dollar peaked the middle of last month. I'm always uncomfortable when the FX excuses start.
It's always
especially when the trend's pretty well established.
Typically, that is a sign that they're trying to excuse weakness on a broader level.
Right.
This could be different, right? Because we are seeing also fundamental weakness overseas, to your point, in Europe in particular.
Nadia Lovell of UBS is going to join us shortly. Maybe we'll touch on this with her. Futures are negative about 0.75% on the S&P, on the Nasdaq 100 down a little more than 1%. Your jobs report is about 34 minutes away, and you're pretty familiar with the estimates at this point. If you're not and you're just tuning in, 318,000 is the median estimate for the May jobs report. The previous number, 428. The number in the next hour.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
matter how you slice it, I think you are seeing a very tight labor market.
We're still seeing a record demand for labor, and the supply side is falling well short.
The Fed needs to loosen that up, or wage pressures will accumulate.
I just don't see unemployment ticking up significantly anytime soon, given how many unfilled jobs there are.
The more of these numbers that we get that show that the economy is slowing but not cratering, that's going to be taking pressure off the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Radio, television, jobs day here in America. We'll see that in 30 minutes. And John, is just simple. Is it Target, flat on its back America, or is it American Airlines to the moon?
There's a data point for everyone, isn't there? But for the airlines, Tom, they're telling you a story about a consumer that's very resilient in the face of higher prices, a company that's being very, very disciplined about capacity. It's not just American, it's Delta, United. I give credit to Scott Kirby, Tom. He said something a year and a half ago that I didn't really believe. The business travel was going to come back and come back really quickly. He was dead on. It's back.
I'm going to go with Scott Kirby and Ed Bastian. I mean, the interviews we've had with airlines guys, with Guy Johnson has done in London as well. There's just been an underestimation of the business spirit that's out there. Will we see that, John, in today's jobs report?
Are we underestimating the resiliency and strength of this economy? And if we are, Tom, a point that Lisa has made, what does that mean about how much work this Federal Reserve needs to do to take some demand out of it to get inflation back down?
Well, Lisa, inflation is a story front and center, certainly for the president speaking later today, and for the Secretary of Labor speaking with John here after the report.
How are they going to try to position a strong labor market with this idea of high inflation and the desire for the Federal Reserve to act, to do something, whereas the only thing that they can really do is to suppress the demand and, in essence, cause unemployment to go up? I mean, it's just twist your head into this logic. How does he spin this, and where are the asymmetries of risk, Tom?
Elon Musk elbowing his way into our jobs report. John, before the data check, we've got to go hard Scott Rodino on you. Twitter out with headlines on Mr. Musk.
The waiting period for the transaction, Tom, I believe, has expired. It has expired. The Twitter deal is subject to remaining closing conditions satisfaction, Tom, whatever that means. I think that Dan Ives of Wedbush this morning called it the elephant in the room. It's been radio silent on this story for a number of weeks now.
Oh, maybe Mr. Musk will go back to 1976 and look at Hart Scott Rodino to figure out what the playbook here is. He doesn't look at it. John, let's do our own Twitter moment here with the data check. I'm going to go, John, to Euro Yen, which shows weak yen, and that's part of a global tension of a potentially boom China.
I'm looking at a 10-year yield, and all of a sudden, you're looking at 3% again.
Yes,
91.68, up about a basis point on a 10-year in America, up 30 basis points in Germany on the week on a 10-year, pushing 130. This line from Citi and Andrew Hollenhorst and the team from moments ago. Here's the quote. The labour market will likely need to loosen, possibly through a recession, to break the increasingly well-established wage price spiral. That's the view from Citi this morning, Tom, going into a jobs number 27 minutes away.
And that's the cold porridge that Alan Ruskin of Deutsche Bank talked about out there somewhere. Right now, before we go to important economics before the jobs report, Nadia Lovell on the physics, the math of this stock market, U.S. equity strategist, UBS Global Wealth Management. Nadia, there's American Airlines booming. How do you treat sector-to-sector analysis now, given the uncertainties of the American recovery?
Yeah, I think what you're seeing from their airlines is just continued evidence of the shifting that's happening in consumer spending away from goods and towards services. I mean, this is why one of the reasons why we have a least preferred on the consumer segment of the market, because we do think that the shift is happening faster than expected. It has implications for inventory is building in some of the channels, and that has implications for margins and discounting coming forward. And also, these sectors are still seeing cost pressures. It's becoming more difficult to pass along that third and fourth price increase to the consumer. And so this is why we think that there is some risk to the downside to earnings expectations within the consumer discretionary areas of the market.
Nadia, with that in mind, looking at the retailers, they've been punished year to date. You look at the airlines, they've got a good story to tell. You've got a resilient consumer. They're being very disciplined on capacity. I've got some relative outperformance. In absolute terms, the stock is still down for the likes of American Airlines on the year by a couple of percentage points. Do I just avoid the whole thing then?
I don't think so. Within industrials, we are neutrals, but we do think that, there are some pockets of opportunity in this recovery that's happening in airlines, not only in leisure. Americans want to get out this summer and travel, but also a return of business travel, which we've been waiting for quite some time to happen. We're starting to see that happen. So there's definitely some areas of opportunities within the airline segments of industrials.
But Nadia, on a broader level, what's going to drive the index higher, given that you are seeing downgrades to your earnings estimates, and that will likely continue?
I think what is going to drive this index higher, as you noted, we did bring down our earnings expectation for 2023 down to 4%. We just think that the consensus is still too high at 10%. But what could drive this market higher is if we see an alleviation in the inflationary pressure happening faster than expected. If we get to, of course, PCE of closer to 2% by the end of the year, a resolution in the war in Ukraine could help that. Also, a gradual phasing out of the China's zero COVID policy could also help that in terms of limiting the disruption to supply chains. But we wouldn't want China to open the floodgates right away just because of the implications of demand to commodity processed products that are already seeing elevated prices. We wouldn't want to see a spike in commodities because that could be destructive to demand.
Nadia, we've been talking about Elon Musk all morning and this proclamation that he had to some of the executives at Tesla about cutting 10% of the staff because of a super bad feeling. Aside from Elon Muskisms, how much does this represent a feeling more broadly that's not just coming from supply chain disruptions, but a sense that things are getting worse and that, as you say, Nadia, it's getting harder to pass along price increases and that a lot of these companies will have to bring in some of their staffing ambitions?
I wouldn't say we don't have a super bad feeling because we don't think that a recession is imminent. We don't see one on the horizon in the next 12 months. We put the probability at under 30%. However, we do expect a slowdown in the economy, and I think that that's needed. That's what the Fed wants, particularly on the labor market side. We need to see the labor market cool off so that the Fed can manage this economy and avoid a recession and we not have a wage spiral cycle. And so I think that that's what you're starting to hear from corporations. Again, that's also why we brought down our earnings expectations, because you are seeing potentially some softness in corporate activity and also some softness in corporate sentiments, which has implications for PMIs going forward, which are so closely linked to earnings expectations and overall S&P performance.
And Nadia, what's your year-end price target for the S&P?
We are looking for 4,300, so we don't see a lot of upside left to this market from this stage, and we're not calling for any new highs over the next 12 months.
Is she saying we can take off the next 9 months?
I'm not sure that's what she's saying.
No, there's a lot to do, Tom, under the hood. There's still trades to be made. It's not about going out and buying the broad market.
Trades to be made.
Get active, Tom, is
Maybe
what I
on
keep
Twitter.
hearing.
Yeah.
The passive trade at the headline number. The reason I asked that, Nadia, because I knew the answer and I wanted to ask another question. I want to ask this. Is the reason it's 4,300, this idea that if we go above that, it's seen by this Federal Reserve as an unwarranted easing of financial conditions and they have to lean against it?
No. Our earnings, our expectations are really driven by earnings. At the end of the day, it's the market follows earnings. So we have taken down our earnings expectations. We also think that valuation P multiples have come in far enough. And we don't think that the Fed, even if we go above 4,300, I think that the Fed would get concerned if you're approaching 5,000 again. But we don't think that that's likely, just given the fact that economic activity is slowing.
Nadia, thank you. As always, brilliant. Nadia Lovell there of UBS Global Wealth Management, 4,300, the price target year end, Tom. A lot of work to do beneath the surface. Not the first time we've heard that.
Yeah, I mean, there we are, and we'll see what the data is, and also we'll see how the revenue dynamics of the companies are given robust nominal GDP. Yeah, it's going to decline, John, but to where? On Twitter, John, this is not a small issue. This is Hart Scott Rodino and Peter Rodino, the giant from New Jersey who was involved in the Nixon impeachment. And he talked near the end of his life. Peter Rodino talked about how this was merger enforcement competition. What happens on this Friday after the jobs report? What do the attorneys for Mr. Musk tell him?
Clearly the strategy from Twitter, Tom, just following this, is just to keep playing by the rules.
Yeah,
keep playing by
absolutely.
the rules. Keep coming out with a series of disclosures and say, this hasn't happened, it was meant to happen. This hasn't happened, it was meant to happen. And Lisa, where we end up, does anyone think this deal is getting done? I mean, that's the question.
Honestly, given the fact that we've got a $40 share price? Probably not. People don't seem to think so, given that you've got a discount of $14.20 baked into there versus the price that Elon Musk put out there. Whether it gets done or not, how much carnage has already been done to Twitter, given some of the departures, given some of the morale hit, given the fact that there is such great uncertainty as to the trajectory of the company?
Tesla down 4 or 5 percentage points. That's got to be where the story is for me. You've got one of the biggest auto manufacturers by market cap on the planet coming out and telling you they've got a super bad feeling, they want to pause hiring, and they maybe even want to cut the workforce by 10%. Tom, any other manufacturer, let's say it was Volkswagen, Daimler, Renault, take your pick. Any other manufacturer comes out and says that, it's headlines everywhere about a macroeconomic story. For some reason, Elon Musk of Tesla says it, and everyone's like,
maybe not.
Really? What does that mean?
Maybe not Chairman Gensler, but I don't get it, John. I just simply don't get it. You're 100% correct. He plays by a different rule book, and it's simple. They've allowed him to.
But we respond to it as well, Tom, in a different way.
Yeah, okay.
In a very different way.
We're the media. I mean, where are the authorities on this to say you got to play by the same rule book as everybody else? Clearly, they're not evident.
Futures down 0.7 on the S&P, on the Nasdaq down about 1.1%. The jobs report 19 minutes away. You know the numbers. If you don't, and you're just tuning in, 318,000 is the median estimate in our Bloomberg survey. The previous number, 428K. Mike McKee with a big number in about 18 minutes.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. We're less than 20 minutes away from today's US unemployment report, and it's likely to show the smallest gain in jobs since April of 2021. The median estimate in the Bloomberg survey says 318,000 jobs were added in May. Meanwhile, the report also may show a downshift in average hourly earnings growth. Tesla CEO Elon Musk reportedly has told executives the electric car maker needs to cut staff by about 10%. According to Reuters, Musk sent out an email titled "Pause All Hiring Worldwide." The report says that Musk wrote that he had a, quote, super bad feeling about the economy. A 10% cut at Tesla would mean a loss of around 10,000 jobs. According to the UK's Defence Ministry, Russian forces now hold the initiative in Ukraine 100 days since Vladimir Putin launched the invasion. British officials say the Russians have gained momentum in their push to capture the Donbass region. They say the original Russian plan failed, but Moscow has since changed its goals and is now focused on the Donbass. And President Biden is pleading with Congress to toughen gun laws following a number of mass killings. In an evening address from the White House, the president called for a ban on assault weapons and high-capacity magazines. He acknowledged that lawmakers are unlikely to ban the weapons, so the president called for raising the age to buy them from 18 to 21. Bristol Myers Squibb has agreed to buy Turning Point Therapeutics, the developer of a lung cancer drug that is expected to launch next year. The all-cash deal is valued at $4.1 billion. Turning Point's shares more than doubled in pre-market trade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
it'll just go straight to neutral. And then I think they're going to wait and see. They don't want to cause a recession. And that's why they're fine going to neutral. That's just taking their foot off the gas pedal a bit. But once they get to neutral and have to get into actual significant tightening, I think they're going to be a lot more cautious.
Megan Green there, the global chief economist at the Kroll Institute from New York City. We are 12 minutes away from your jobs report. Your data looks like this. Equities lower by 0.6% on the S&P. On the Nasdaq down a little more than 1%. Yields higher by almost a basis point. 291.68 on a 10-year. Crude 117.11, up 0.2%. Tom, you know the estimate well. Close to 320 is the estimate going into this jobs report.
I'll see that in 12 minutes here, folks. I'll be looking at the usual data, the strength of the economy. I know Lisa's looking at labor participation. Right now, participating with us, Randall Krosner. He's a former Fed governor and, of course, with Chicago Booth School, opening up their London shop and doing good work for Chicago from finance over to economics. Governor Krosner, thank you so much for joining today. I want to talk about this jobs report, the inflation that is clear, and what it means for a new middle class. Pew Research shows a shrinking of the middle class due to the success of prosperity in America. How flat on their back on this jobs report is the American middle class?
Well, there are a lot of opportunities for jobs right now. I mean, there are something like 2 job openings for every unemployed worker. That's really quite extraordinary. So there are a lot of opportunities out there. Have all the opportunities been taken advantage of? Is everything sort of equally spread? For sure not. But there's certainly a lot of opportunities there.
But 300,000 payrolls is not fully employed. That is a real job formation number. And I don't need a single point estimate. I know that's not your game. But do you assume in a fully employed America we go back to 175 or 200,000 non-farm payrolls?
Well, we probably go down from where we are. Remember, the unemployment rate is at near 40, 50-year lows. I mean, you're under 4%. We haven't had that many periods of sustained under 4% unemployment. But one of the issues that you raised is about people who are outside of the job markets, who are not counted as unemployed, that labor force participation ratio. That has not gone up as high as it was pre-pandemic. A lot of that now is sort of older workers who would come back in, but for a variety of reasons, including health reasons, are a little wary of getting back into the market.
Randy, how do you look at the noise that we're seeing in the data? Because there is a narrative and there's a data point to back any narrative that you have right now. How do you look through it and get a leading indicator that gives you some sense of where the jobs number will go in June, in July?
Yeah, certainly when there's a lot of volatility and potential turning points in the economy, people can pick out different pieces of data and develop different narratives. And that just comes when when things are a bit volatile. So certainly in this jobs report, we're looking at both the unemployment rate, but certainly the number of jobs that are created, looking across the different sectors, looking at labor force participation, and also seeing what's going to happen to wages. That's a real wild card and something that the Fed focuses on a lot.
When we look at the participation rate that we've been talking about all morning, what are you expecting in terms of people coming back in? You were saying that there are a lot of people who cannot come back in for health reasons, for skills reasons. What does that mean in terms of the tightness?
So I think the labor market is pretty darn tight. As I said, we've got 2 job vacancies for every unemployed person. That's awfully high, and so there are a lot of opportunities, but there's a lot of tightness that's there. But also, as you mentioned, there's a bit of a mismatch. So sometimes the job openings are there, but you just can't find people who have the skills in the right location for what the firms want.
Professor Krosner, let's channel the magnificent Alan Meltzer. We are in the middle of Jackson Hole planning, and Alan Meltzer once took me to task on the tundra of Jackson Hole by saying that we need to sum, we need to aggregate, we need to go macro. In this jobs economy, should we sum everybody together, or do you partition out parts of the American labor economy?
So I think certainly from the Fed's point of view, they've got to look at the big macro picture. But as I was just discussing with Lisa, to try to look at what's going to happen, I think you have to pair it into some of the different pieces to see what's happening in hospitality and leisure, what's happening in some of these different sectors to understand, well, is this really a supply constraint or a bit more of a demand constraint?
Why does it matter, Randy, if we have Jay Powell coming out and saying nuance doesn't matter here? At a certain point, even if it's supply side driven, can this be something that they let slide given the fact that the only tool they have is to dampen demand and they cannot allow inflation to remain at the level that it is?
Yes, I think I've said to you guys before, regardless of whether it's supply or demand, it's supply and demand coming together, and the Fed owns it. If inflation is high, people turn to the Fed and say, what's going on? You've got to do something about it. Jay can't simply say, oh, well, that's not my fault. I can't produce more chips. I can't drill more oil. That's not a good explanation. You can try to get away with that for 2 or 3 months and say that it's transitory, but after it's persisted for more than a year, it's their problem, and they have to worry about inflation expectations, regardless of what the source of the increase in reported inflation is.
Randy, are you prepared to call this a wage price spiral? Citi are there. Are you there?
So I think we're not there yet. We certainly are seeing elevated wage increases, but we're not seeing, they have not on average exceeded inflation. Inflation's, depending on your favorite measure, somewhere between, 8 or 9%. And wage growth has been more in the 4 to 6% range, again, depending on your favorite measure. But that's pretty significant growth compared to where we were before. The real worry is that as inflation comes down, as I think it's likely to at some point, not anywhere close to the 2% target soon, but I think it's likely to come down. Are you going to continue to see wage demands in the 5% or so range if inflation is 4%? That can be a little bit tougher, and that's when you start to see a real change in the labor market. If real wages are going up very significantly, or people are demanding very high wage increases and demand is falling off, that's when you can get into a little bit of trouble.
If I'm a policymaker, my favorite measure is the lower one. Randy, you know how it works. Randy Krosner there of the University of Chicago Booth School is going to stick with us for reaction to the payrolls report, Tom, in about 2 minutes' time.
It's fascinating. I'm sorry, John. And Meltzer and I would argue about this constructively, and of course, always with homage to the great from UCLA and Carnegie Mellon. I don't know how you aggregate this American economy in a modern economy. Working with Krosner in Chicago was Gary Becker and Sherwin Rosen, and they said, look, we're different. We can improve. There's a part of an America, John, improving every week, and there's a part left behind. I don't know how you aggregate that.
Left behind and getting squeezed, and Tom, that's been a problem for a long time. That predates the pandemic as well. It's been a big issue. Looking ahead to payrolls, here's your estimate, 320K. Lisa, is there a Goldilocks number for this market? A miss to the downside that perhaps we appreciate?
Is it the headline number that's going to be the Goldilocks number, or is it something underneath? And perhaps it has to do with wages coming in a little bit or not increasing as quickly, or the participation rate. Give us a number, and you'll get 5 different views on what that could mean for markets.
Mike McKee will give you a number in 4 minutes' time. Equity futures down 0.6% on the S&P. On the Nasdaq, down 1 full percentage point. The estimate is 320K. The previous number is 428. The official number is up next.
At GIA, we grade some of the rarest, most precious diamonds in the world, including yours. Feel confident you're choosing the best with a diamond graded by GIA.
You will put a woman on Mars. You will be the first chief crypto officer, because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
jobs report in America 10 seconds away. The price action coming into it looks like this. Futures negative 0.7% on the S&P. On the Nasdaq 100 down 1 full percentage point. With your jobs report in America, here's Mike McKee.
Comes in much better than anticipated, John. 390,000 jobs were restored last month. The forecast had dropped to 318 after that ADP number. The change in private payrolls, even better, 333,000. Of course, both of those are down from last month. Last month, we'd seen 428,000 and 406,000 for private. But manufacturing payrolls come in up 18,000. Those numbers from the prior month down 22,000. We've had a revision lower. So it does look like the economy may be slowing down just a little bit. The unemployment rate stays at 3.6%. We had anticipated in the Bloomberg survey it would drop to 3.5%. In part, that may be because the labor participation rate didn't move all that much. It does tick up to 62.3, the expectation from 62.2. But we'll have to go underneath the numbers to get a better picture of what happened on the household side. Average hourly earnings, that's the big number everybody's watching, come in weaker than anticipated. 0.3% higher for the month, 5.2% on a year-over-year basis, which is down from 5.5%. Now, in this kind of upside-down world that we've seen, guys, this is probably good news for the Fed. The numbers are weaker than expected, but still strong. So they do show maybe signs of a decelerating economy and decelerating inflation pressures without suggesting that the economy is going to fall off a cliff.
This one won't settle any arguments. Let's push this through this market. Futures recover just a little bit, still negative 0.5% on the S&P. If you look at the bond market, yields with a lift by a couple of basis points at the front end to 265. Further along the curve, up by 3 or 4 basis points to 294. No major changes, TK, off the back of this one.
Well, they're not, but I'm going to do some math here, John, and I'm sorry, with the revision up in the last 60 days, John, we've created an average of 413,000 jobs per month. And I'm sorry, it's a job formation machine.
Neil Dutcher of Renaissance Macro calling it Goldilocks-ish. Mike McKee, does that resonate with you?
Yeah, I think that's a fairly good way you could describe it, given the situation. This is only the beginning of what is supposed to be happening, but we've talked about this, and I know you guys have talked about it with some of your guests. The idea that because the markets have front-run the Fed a lot and have pushed rates up, you look at the whole yield curve, it's above where they think neutral is. Maybe we're seeing transmission a little bit more quickly into the economy, and that would be good news overall for the Fed. The biggest change that we have seen in terms of the employment data seems to be in leisure and hospitality, again, up by 84,000 for the month. Food and drinking places up by 46,000. Now, of course, we're getting into the summer season when there would be more people going into the leisure business. We'd see some of the amusement parks and things open up, so there'll be some seasonal questions about that. But professional and business services still falling off a cliff.
Mike McKee, thank you. Great work as always. Let's talk about the ish of the Goldilocks-ish, Tom. You've got an upside surprise on a headline number, and to Mike's point, you go through this, the unemployment rate at 3.6%. Number, any number, I can give it you now. Which one would it be? She said the participation rate. Just a little bit of a lift there, Tom. It's not a massive move. It's not dramatic. But if you were sitting here and you were the Federal Reserve, what you'd like to see over a series of months was just for that supply side story to improve, Tom, without that inflationary experience being exacerbated by a much tighter labor market.
I'm going to give you no drama. I'll get it. Let me round it up here. You go from 292 to a 295 10-year yield. You're on your way back to that 3% number.
All of a sudden with that, Tom, we've had a move of, I think, more than 20 basis points now on the week on a 10-year Treasury, put together with what would happen with a German 10-year Bund, which is up about 30 basis points. It's been a big week for yields.
Randall Krasner with us for some observations here, of course, with the Booth School of Chicago, the former former Fed governor. Randy, I want to talk about what the Fed actually does around the table at the Eccles building with this report. Do they value an analysis of the inflation-adjusted wage? Does the real wage matter?
Sure it does, because they're looking both at the inflation to see where expectations are, what is happening in the labor market, and then they look at adjusting for inflation. Are real wages exploding? They're certainly not exploding. We've got inflation that's much higher than the roughly 5.5% growth of wages. And so I think, as you were saying, the Fed is going to take this as this is kind of what we were anticipating, that we're not seeing an explosion on the wage side. We're not seeing a collapse of the economy either. I mean, these are still very strong numbers. The unemployment rate at 3.6% is still an extremely strong number. It's very rare that the U.S. economy has a sustained unemployment rate below 4%. And so I think it's very much consistent with the Fed's forecasts. And so that means there's nothing that's going to stop them from continuing this march of 50 basis point increases. And as my former colleague from graduate school, Lael Brainerd, said, they're going to be marching through at least September in those 50 basis point rate increases.
Well, that's exactly where I wanted to go, Randy. Does this jobs report give credence to the idea that they could go 50 basis points, 3 meetings in a row, and then follow it on with another 50 basis point rate hike, even though last week some, including Raphael Bostic, were talking about a pause?
So I mean, as they always say, they're data dependent. We have to see how the data come. But if you get reports like this, it's going to give Fed the confidence that they are doing the right thing, that they're starting to have a little bit of an impact on inflation, and hopefully once they get in the 2.5–3% range, they'll have more of an impact. Inflation expectations have not gotten out of control. The short-term expectations are super high, but that makes a lot of sense. But the intermediate to longer run expectations are really not much out of the range where they've been over the last decade. And this is why the Fed needs to act now. And this is why I think Lael was out there saying, we're going to be tough on inflation, because they have an opportunity. The opportunity is to raise those rates now when the unemployment rate is low, without inflation expectations getting out of control. As long as they stay well anchored, they can move into, let's say, around 3% or so. And then hopefully we'll start to see the inflation start to come down. And then they'll be sitting pretty, because they won't have to raise rates to those double-digit levels, which is where we were 40 years ago when inflation was this high.
Great to catch up, Randy, to get your thoughts on this. Randy Krosner there of the University of Chicago Booth School. The conclusion for him, the Fed has got more work to do. The story for us, equities not really changing off the back of this, down by 0.6% on the S&P, on the Nasdaq off by about 1 percentage point. Yields higher by 5 basis points to 295.89. Going to get a ton of input on the fixed income market in the next hour. We'll do that with Rick Reeder of BlackRock, Mike Collins of PGIM, Subhadra Japa of SocGen. TK, looking forward to that on Bloomberg TV in around about 22 minutes.
Continue the discussion here, and I also want to note the real yield of 0.28% elevated, and look for John this afternoon on the real yield. Right now joining us, Jeffrey Rosenberg with BlackRock. And Jeff, perfect time to talk to you. I want to know how the bond market responds to one of the themes we've seen, and maybe we see in this jobs report, which is we're going to move from 8% to 5% inflation or 4% inflation, and then there's a massive then what? How do you position in bonds given a bipart move in inflation and presumably in yield?
Yeah, and a week from now, we're going to have that conversation again with maybe a little bit more relevant information focused on, the CPI report. But the inflationary data that we get out of today, as you guys have covered, it's a little bit of, avoiding the worst case scenario. You get a little bit of improvement on the labor force participation rate. I would agree with whoever said that earlier. That's probably, for the inflation story, the biggest important number that we get out of the payroll report. Obviously, there's an average average hourly earnings as well, and that, you know, avoided a negative disappointment in terms of, you know, fast print. You know, I think the market this morning is maybe reacting on the headline. Yeah, there's a pretty big drag to that headline number from retail. You know, so if you discount that, this was actually a little bit stronger report. You know, perhaps that's what we're seeing in terms of the market. And as Randy just said, you know, take a step back, 390,000. This is still a very, very strong and too strong labor market. So we need to see that slow. And, you know, that's in the expectations, and you're getting a little bit of that, maybe a little bit of disappointment in terms of the slowing. I wouldn't read too much into it. And to your question, Tom, you know, the jury is still out in terms of the inflationary trajectory. We're projecting it. Fair. We have expectations that we're going to see that decline. But you can't get the Fed really out of the business of focusing on the number one priority, which is getting inflation down, until you start to really see definitively that show up. And until that happens, it's going to be a very tough time to be thinking about, you know, bonds in the portfolio as an equity hedge, bonds as, you know, stable source of income and preservation of principal, because they've got to adjust. Now, the good news is there's been a lot of adjustments. So I think the pain that we've seen in the first quarter, unlikely to be repeated, but too early here on this report to say it's all clear.
As traders parse through the numbers, you are seeing a bit more of a lift to yields priced down on bonds, to your point, Jeff. And you're also seeing stocks get hit a little bit more, perhaps because it is still too hot for the Fed. I wonder, though, how much, Jeff, this market continues to be faith-based in terms of pick your data point, pick your narrative, confirm it, and move on. How much is that sort of what you're feeling right now?
Yeah, I mean, look, we all are going to have various interpretations on the data, and so will the Fed. But eventually, the data will show up, and it's not just one data point or two from which we extrapolate. And we have to be a little bit patient. We have to be a little bit patient to see that trajectory play out. The market may not be patient. You know, one comment from Bostic, and everybody says, "Oh, it's okay." You know, they're going to pause, and then Brainerd, you know, tries to put that back in the bottle. So really, we got to focus not on, you know, being sort of yanked around by various comments, but understand that the priority here is inflation, and that means a consecutive set of inflation prints monthly. You know, so we've got to really follow this over the course of the summer into the fall before we can really definitively claim that the projections, the faith-based projections in the consensus expectations, are actually being realized.
Jeff, it's a chart that we have tattooed to our brains, and certainly you do with all your work at Carnegie Mellon. The 10-year real yield, the inflation-adjusted 10-year yield, given these uncertain times, that the real yield has to get back to.
Yeah, it's a great question, Tom, because it really is kind of the North Star for thinking about Fed policy. You know, the Fed wants to get back to neutral. You know, what is neutral? Well, first of all, neutral in real terms is a lot closer to zero, probably between 0.5%. But to get there, you need, you know, both an increase in nominal yields and a decrease in inflation. And if inflation doesn't do its part to decrease, then you need more increases in nominal yields. So when people kind of think about the 3% that the Fed's going to very quickly get to, you know, by the end of this year, early part of next year, the presumption there is that the inflation is also going to decline and do its part, and that's going to bring real yields back to something that's closer to neutral. So if you don't get that contribution from inflation, then you are going to need to see more on the nominal rate hikes to get closer to neutral. So there's two parts to that nominal rate forecast that's kind of embedded in bond prices, and a big part of that is a steady decline in the inflation rate.
Jeff, in about 2 hours, President Biden is going to come out and talk about how the strength of this labor market is going to allow the nation to navigate through a difficult period of time. He will talk about how it's one of the strongest labor markets in history. How do you look at that and then confirm the sort of bearish tilt of the market that's looking to recession, that's looking to a slowdown, and looking to an increase in the unemployment rate?
Well, it's about kind of setting expectations. I think some of the things we've seen from the administration is trying to get out ahead of labor market slowdown, but also slowdown here is a good thing. And that's a little bit tricky of a message for them to say because it's all been about these great job numbers and how good that is. Now they've got to pivot to talk about the sustainability of the economy, and that too much of a good thing is actually a bad thing because of its impact on inflation. And so seeing this steady decline in payroll figures is actually something that we should look forward to and would be a good outcome. So I think it's kind of turning their narrative. It's what the market is looking for as well, and that's where this kind of bad news is good news in some sense, is in the market expectation.
Jeff Rosenberg, thank you so much with BlackRock after this jobs report. It's a jobs report that still roils the markets. Here, I'm going to call the VIX out of stick, 25.59 with the NASDAQ down 1.5%. Dow Jones Industrial Average down 215 points and SPX down 39. And some real movement in bonds. John and I were talking about 3% 10-year yield. You're almost there, 2.97% with a 6 basis point move. Oil with a 118 print. Moving nicely, dollar stronger, and I really want to point on a global basis into this Friday in America, dollar yen now fully buttressed up against yen weakness. Lisa, the yen weakness of a 131 rounded up is tangible.
Yeah, the dollar strength highlighting this fear that the U.S. will be able to move well ahead of other central banks. I think it's notable when you take a look at the bond space, Tom, that you're seeing the longer end actually sell off more. Basically, that perhaps the Fed will look to some guidance from the fact that wages have not increased more and say we can hold off and allow inflation to pick up more on the back end. That is sort of the subtle message under the moves, Tom.
She just spoke with Elon Musk. We now speak with Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist. That was a joke, folks. Mr. Musk has had an eventful 24 hours. Gina Martin Adams, how do you and your team write equity with the buy part of a booming airline business and retail flat on their back, and there's 14 other sectors as well? How do you address that for Monday morning?
Well, I think what you want to really focus on is a few things impacting the equity market. First, the rates reaction to the employment market. The employment report is the most important thing that you want to watch. We are clearly in a market that is being led around by the bond market. Valuations have been responsible for the entirety of the S&P 500 correction so far, as earnings are still growing. That tells you a lot about what's really driving the equity market trend. But as far as the consumer, you allude to airlines versus retail. It's very normal at this stage of the cycle, frankly, as rates start to rise, for the consumer to transition to spending more on